Hello, everyone. Thanks for joining us today. As before, the webinar will be led by Jerome Stern and our CIO, Chris Rosbach. They're joined today by Giles Tulloch, who leads on our technology investments and is just back from a week in Silicon Valley and Seattle on an AI-focused trip. We already have some great questions, and please do send more at any time during the call. I will now hand over to Jerome.
Thank you, Sandy. A warm welcome also from me to our third 2025 WorldStars Global Equity webinar. A quick note to start. This has now been 5 years that we've been organizing webinars, which we find a great way to be able to keep in touch with our investors and friends. We wanted to thank everyone for their time and for their relentless engagement. For today, we look forward to a great update and conversation with Chris and Giles. Quick background for the newer participants. We are an investment partnership managing $2.4 billion of AUM on behalf of institutions, endowments, wealth managers, and families, 20% of which on behalf of my family, our partners and employees, providing investors with an unparalleled, powerful alignment. As an independent institutional asset manager, we manage 4 investment strategies on behalf of long-term investors based on fundamental research with a core focus on quality. Our sole mission as a firm is to deliver strong long-term returns on behalf of our investors. Our flagship investment strategy, WorldStars Global Equity, represents $2 billion of AUM, of which $426 million in a Luxembourg UCITS fund and another $540 million in our Delaware LP fund, available to eligible US investors. WorldStars invests in a concentrated portfolio of quality global companies for the long term. This conviction-led approach leads to a high active share, low turnover portfolio, which has delivered 11.7% per annum net of fees in US dollars and 13.2% per annum in British pounds for the past 10 years. And this with controlled levels of risk. This performance builds on the quality of our investment proposition, the stability of our investment team, the repeatability of our institutional investment process, and naturally, WorldStars' available investment capacity. Moving on, how we define quality. As many of you will have heard, quality is the defining condition for us to invest in a company. We define quality as strong and sustainable market positions in good and growing industries, with companies led by management teams with long track records of value creation, and balance sheet which are so strong that it can weather any type of adversity. We scrutinize those hard qualitative and quantitative criteria in a disciplined manner, making this the cornerstone of our investment process. At the end of the day, we want to invest in enduring, high-quality companies with powerful business models, higher growth profiles, proven resilience, enabling us to protect and compound capital for the long term. This definition of quality leads us to invest in 4 key buckets. Digital transformation, which represents 43% of the strategy. Consumer, representing 17%. Healthcare and life sciences, 16%. And industrials and infrastructure, which accounts for 25% of the strategy. And by the way, we're overweight in both of those, which we see as a key differentiator within the quality growth universe. Similarly, our relentless focus on quality makes us avoid balance sheet-driven financials, regulated businesses, resource-based industries, as well as capital-intensive businesses. Chris, over to you.
Excellent. Thank you very much, Jerome, and welcome everybody to this update. I think we can certainly say that we're looking back at a certainly eventful quarter and beginning of the year. It's been clearly defined by the Trump administration, by the policies that President Trump has now not just announced, but is in the process of implementing. And the quarter has seen significant volatility. The primary one is clearly around Liberation Day and the ongoing tariff policies that are still under discussion. We are the companies we invest in, as well as we investors are dealing with, but it's clearly also the foreign policy measures that he's taken. It's the cuts to U.S. government spending and the impact that those will have, and it is the budget bill, which has now gone through in a way that is going to have a significant impact going forward. I think at the same time, and I think that's been consistent with what we've said from the beginning of the year, we thought that the U.S. economy in particular, but also others in Europe, in China and elsewhere, were set up for what was going to be a very robust year with inflation in check, with underlying growth, strong employment, income, and personal balance sheets all pointing to resilience. And so we've had this period in which we've had these forces that have offset one another, these strong underlying fundamentals coming through in corporate results, but at the same time, the uncertainty from the policy steps affecting things. And that, I think, is certainly what we've seen during the quarter. The significant sell-off that took place as result of the concerns around the policies, but then the very strong recovery that we've seen. One, as we've seen that pragmatism has prevailed, at least so far, and that guardrails have held, in particular guardrails that are imposed by markets, by bond markets, and also by equity markets that have constrained some of the policies and that have put us in a position where it looks like there is a more pragmatic landing zone for where tariffs may end up, and whether the deadline was the beginning of July, as it turns out it's not, whether it's August 1st, as we understand, whether it's the end of the summer. Clearly the negotiations are ongoing, but the strongest set of tariffs are clearly not being imposed, and every day we see signs that there are negotiations for different outcomes. I think the very most recent one that, of course, affects NVIDIA, our largest position, is the announcement that the NVIDIA has been encouraged to apply for H20 permits to be sold to China, and that those were likely to be granted, which is, I think, another sign of the negotiations that are taking place around trade with China, and point to a pragmatic approach that the administration is taking, at the same time as they think that the uncertainty that they're creating helps them to create negotiation leverage, as they think that taking extreme positions moves the area of agreement, and they're looking to change the overall balance of things. So that, I think, is a part of the backdrop that we've seen. But what matters to us, of course, is the fundamentals of the companies, and those so far have been very resilient. If you look at the performance over the last 3 months, you can see that that's been resilient. The strategy is up 11%. After fees, 11.3% before fees over the period. So that is strong absolute performance. It also means that on a year-to-date basis, as of the end of June, it has performed well. And of course, that is also carried on now into July. We had a period of outperformance at the beginning of the year. We've underperformed relative to the MSCI World for a couple of months as a result of both factor and individual stock selection issues, largely due to the impact of the policies that are being put in place. And we'll talk about that in a moment to give you some more detail. But I think the big picture is that we continue to be convinced of the resilience of the quality businesses that we have. The criteria that Jerome just took us through show you what we're looking for, but it is the global leaders in their businesses that have the competitive positions, that have the exposure to underlying growth that continues to be resilient, that have the managements, and that, very importantly, have the balance sheets and the financial resources. These are the companies that can act and don't have to react, including in the uncertain environment that we're in, and that are also able to realign their businesses in terms of what the impact of the tariffs may be. And so we think that these businesses are well positioned to prevail in this current environment and to get through the adversity stronger. And as we've seen in particular in the rebound that has taken place, that has also been borne out where companies have already shown that the underlying business that they have, the demand for what they do or the services they provide has meant that the results have remained resilient, so that now we're in a position as we're looking forward to the second quarter results and the guidance that companies provide to see how much of this is effectively already in what companies are expecting and how much of it is what the delayed impact of the issues around confidence in corporate spending, confidence in consumer spending, the impact of tariffs may bring for the second half of the year. But let's move forward from this perspective to look at some of the detail that's behind the performance. So on the next page, you can see a chart that we've shown in the past, which is around the stock selection, the active return, and the factor return that impacts it. And as you can see, in aggregate, the stock selection has been what has been driving the performance over time. But it is very notable to see that as the active return has declined over the period over the last 5 years, you can see it's first an impact of the factor return of the portfolio. So the impact in part of the effectively Trump trade, the fact that we look to avoid, as Jerome just reminded us, balance sheet driven financials, so banks and insurance companies, as well as resource and capital intensive businesses, in particular energy and utilities. All of these, as we know, are sectors of the market that performed strongly as in the second half of last year and also into the beginning of this, as there's been a revaluation. We think much of that has already taken place. We'll show in a moment some of the valuation metrics that we think underpin that, but where there are areas where there is effectively a catch-up potential, then that will take place. But we think that these are not businesses that fulfill the quality criteria that we have, and we don't think, even though from time to time they will perform, they are not the type of long-term compounding businesses that we want to be invested in, that we think can generate strong long-term returns over time. The stock selection does matter as well, and we've had both issues that relate to the impact of the uncertainty on companies, as well as some of the specific actions that the Trump administration has taken that have impacted some of the companies that we've invested in, and we'll show you some detail around that to explain where that is. When we have periods in which the stock selection declines, then this is allows us to focus our research on those companies, to re-underwrite them as part of our investment process, to assess what the issues are, and to decide whether our conviction is, the hypothesis continues to be valid, whether our conviction remains the same, or whether we need to make changes and take advantage of opportunities that we see both from within the portfolio as well as from stocks that we have on our watch list and on our approved list, because it's obviously not just the stocks we have in the portfolio, but it's also others that are impacted. And that means that times like these, where we have this uncertainty, where we have this market volatility, are also times of opportunity for us to find companies, to potentially find even higher quality companies that are now at valuation levels that we think are attractive and that allow us to take advantage of these opportunities. So if we move forward and we just look at the second quarter returns in this slide, where we show you a bar chart that is coded by the industries that we prefer for our portfolio. The dark blue is industrials, the light blue is tech, the pink is the consumers, and the gray is healthcare, as you see there. And you can see quite a pattern, I think, both in terms of some of the individual companies, as well as with some of the underlying drivers of the businesses as we look at them. You can see that the top performers for the quarter were Amphenol NVIDIA, Eaton, Meta, and Disney. So two of the very high quality industrial companies that we invest in, as well as in two of the tech companies to some extent. That is ongoing strong performance for the year. In other cases, it's actually a rebound. We will hear about NVIDIA and the overall potential of AI from Giles in a moment, but clearly that has had quite a series of performances during the year, driven first by the concerns and then by the affirmation of the demand for the analysis of data and for computing power. So we continue to believe in that as our largest position and think that it continues to be attractively valued. Something similar is true for Meta, but I think importantly also for Amphenol and Eaton, companies that are involved in providing some of the infrastructure that is necessary for the grid, for power management, for data centers and warehouses, for semiconductor fabs, and for electrical vehicle charging. They've had a very strong performance that's backed by the need for investment in those areas. And so we're very happy to see that, and to see that the diversity of the different stocks that we have has allowed us to be resilient and to perform. In the case of Disney, it's a question in part of resilience after clearly a period of adversity, but we continue to believe that it is very well positioned given the strength of its franchise in the parks and the resilience and turnaround in profitability in its streaming business. So it's very good to see that. On the negative side, the pattern, I think, is even clearer. You can see it's in healthcare and in consumer. In healthcare, it's in part stock-specific issues in the case of Zoetis, the leader in animal health, where there's been some holdups in terms of some of the product adoption and some concerns around competition, but we think it's a very cheap company that is attractively valued. In the case of Thermo Fisher, it's concerns around government spending for research. The cuts to the investment that the US government is making through the NIH and other vehicles into US research in life sciences and in other areas is one of the most negative aspects, I think, that we see in terms of the Trump administration policies. And with a company like Thermo Fisher that is a leader in providing equipment that supports that kind of research, it clearly leads to concerns. So I think that's some of these specific areas there. And for LVMH, the concern is more around consumer products and the demand for luxury, effectively a pause in growth after the strong growth that the company and the sector has been able to achieve over the last years, including through the dislocation of the pandemic and the way that that's affected spending patterns. We think that the underlying strength of the business is there, as well as the underlying demand. That it is going to be resilient, and we expect the business to do well going forward. That's some of the perspective on the actual returns for the second quarter. If we move ahead just to look at some of the active weights by GIC sector, so this is now looking at the objective exposure of the portfolio as opposed to our own classification by the underlying drivers. You can see that the positioning continues to be very conservative. The active over and underweights relative to the MSCI World are focused around industrials, around healthcare, around communication services, although you can see that if you combine that with IT, it is only partially an overweight from a GIC sector perspective, and then consumer staples. So a portfolio that, even though it sustains as its largest position NVIDIA, and from our own perspective is benefiting from digital transformation, that is from a GIC sector's perspective continues to be conservatively and we think resiliently positioned, even if that is some of the areas where there are short-term headwinds as a result of what's going on. But you can also see here the underweights in financial and energy, in utilities in particular, which ties in with what I was saying earlier in terms of the explanation of some of the factor returns that we've had, where clearly these have been some of the areas of the market that have done very well as a result of the Trump trade and the revaluation that's taken place. But again, something that is inherent in the approach that we have looking for quality companies that can deliver compounding value over time, and avoiding companies that we think are disrupted and are facing other issues, even if they can be revalued in a kind of value trade from time to time. If we then move forward and look at attribution analysis in terms of looking at what that means in greater detail, this is looking at the last 12 months, so the rolling 12-month period in terms of what the sources for performance and for underperformance have been. And I think what you can see here is just further proof in quantitative terms for what I've been saying. If you see at the areas where there's been both allocation and selection effect to get to the total attribution of returns, you can again see financials and energy as some of the areas where we haven't had exposure. And so that has been some of the detractors from the area. And then I think the other thing that is really notable from there is that in areas like healthcare in particular, as well as in industrials, the stock selection has been positive, and we've been able to add value in attribution terms, whereas you can see that in consumer staples in particular, but also consumer discretionary, are areas where we've been held back. That is in part, you can see from a selection effect perspective, where some of the issues have been in the individual stocks. And again, where we're using as information in terms of doubling down as part of our investment process into the companies to reassess the investment cases and to decide if we continue to have conviction, or if we feel that there are changes that are happening to the companies and to the investment cases that mean that we need to act. So far this year, we have not. We have felt that both the overall shape of the portfolio as well as the individual companies have been in line with what we want to have and how we think these individual positions can generate value, but we are continually reevaluating that and will trade and make decisions when we think the opportunity is warranted. If we move forward to look at this outperformance over time, then I think what you can see here is looking at 5-year rolling periods since inception, that we have very consistently been able to outperform over these longer periods of time, with the 5 to 10-year investment horizon that we have, where we're ideally looking to own companies for 25 years or longer, subject to the quality of the investment case and, of course, to the valuation. We're now in one of these outlying periods. And so I think this is just an indication that when we are in periods like this, it is periods of opportunity, because the tendency of our companies are to then revert to performance and to outperformance if we are in periods that are more challenging. And so with that, I want to switch over and invite Giles to speak to us. He's a partner in our business. We've been working together for more than 10 years and a senior analyst who works in particular on our technology and media and platform investments. And will talk to us about AI, data, and a recent trip that he's had to visit a lot of the leading companies on the West Coast of the US. So Giles?
Great. Thanks so much, Chris. Yes, as you mentioned, I was just out in Silicon Valley in June, meeting with NVIDIA, Broadcom, Marvell, and many other companies in the ecosystem there, as well as traveling up to Seattle to meet with some of the large hyperscaler companies as well. And we really wanted to take this opportunity just to, again, talk about an update on our view on artificial intelligence. And we still remain sort of very positive that we are very much at the early innings of this sort of new technology paradigm that we are embarking. And so I think it's important right now to talk about just the demand for AI. I think one of the bear cases around AI has been it's been a narrow sort of customer set, just the sort of large hyperscale company spending, be it sort of say Meta spending a lot on their sort of artificial intelligence to try and recreate that signal which they'd lost from the sort of Apple IDFA changes. And that's a sort of a narrow use case. We're not seeing tangible ROIs. And I think really coming out of the trip is that we are seeing these effects rippling across the sort of, the economy in lots of different sectors. And we're also seeing as well in 2025, this kind of sort of sovereign AI. It's something that's been talked about in the past, but never really sort of seen the impact coming through. We just had a few announcements I thought would be good to sort of touch upon in 2025, which is showing the sort of next leg of demand for NVIDIA. So we have sort of had Humane, which is the sort of Kingdom of Saudi Arabia's new project. It's going to bring on in total sort of 500 megawatts of capacity. That might not mean too much, but before sort of artificial intelligence took off, the largest data center in the world was about 650 megawatts. So it's pretty much the largest data center in the world, which Humane are sort of planning to sort of build over the next few years. But then, not to be outdone, you've also got Stargate, sort of there on the bottom left. This is a huge project. So the initial build is sort of 200 megawatts in sort of Abilene in Texas, but this can reach a total of 5 gigawatts of power. So be sort of 10 times the size of Humane, and it's going to cost about sort of 500 billion in total investment. It's a project with sort of OpenAI, with SoftBank, with Oracle, and of course NVIDIA as well. And one can sort of think about the sort of cost spend as being half for compute and half for construction. So about sort of 250 billion could be the addressable market for NVIDIA. And this kind of comes also to one sort of rule of thumbs is really 1 gigawatt of power. There's about a 50 billion opportunity for NVIDIA. And then not to be left out, we also have France there on sort of the bottom right-hand side. They've also announced sort of a project to make sort of sizable artificial intelligence investments and build out a data center cluster, which again could reach sort of 1.4 gigawatts of power. So again, we're seeing sort of governments looking at artificial intelligence as part of an essential infrastructure. When we met with NVIDIA, they made the comment that sort of governments are seeing this like water, like electricity, as sort of a key service, and they want to be in control of how artificial intelligence develops in the countries, how they can sort of incubate and grow local AI companies. And so it's all becoming very strategic, and we can kind of see sort of such many legs of demand for AI. But then with AI, you also need to build capacity. So we've also seen as well lots of new capacity being built by foundries. So we can see in the Far East, in sort of Japan and Taiwan, there are plans from TSMC to build more fabs. Also seeing as well in the Middle East, possible sort of building projects to support the sort of KSA Humane project there, as well as also in Europe and in America, where also there's large projects happening. I think it's going to be very difficult in terms of trying to predict the exact timing. It's very difficult to build these sort of data centers, these fabs, sorry. It's very highly technical, but there's just going to be a significant demand for advanced logic. And so we think there's still a very strong structural trend towards advanced semiconductors and this sort of manufacturing. And so this then brings us on to NVIDIA. As I sort of mentioned, we met with NVIDIA last month, and again, sort of it's our large position in the World Stars portfolio, and we remain very confident in the outlook for the business. In our meetings with them, but also with the sort of customers and competitors, they continue to highlight the strong competitive moat surrounding the business. So some companies talked about the pace of innovation. You can see down the right-hand side, the new sort of projects, the sort of Vera Rubin, the Rubin Ultra, as well as they've also talked about Feynman coming out in 2028. And so by providing the strong roadmap ahead, it puts them in a good position with their supply chain. So people can know what they need to build, what sort of specifications. So that's part of our sort of meetings with companies who are part of that supply chain, understanding what sort of constraints and capacity they need to have, but also for the customers as well. So they know kind of how powerful the sort of new solutions are going to be and how do they want to sort of plan and arrange their spending. Also, as well, the CUDA software platform is a very strong competitive advantage for NVIDIA. When we spoke with some of the competitors, they talked about how difficult it was to try to work in a sort of different code, how much expense it costs to support this different instruction set. And by having a common sort of platform of CUDA, it makes it easier for everyone to work. And then also as well, the full stack approach. By selling silicon, software, networking, it all just works. It's a little bit like Apple, really, where if you have the all-in-one ecosystem and the products all benefit from each other, it's a one-stop shop. You can deploy it very quickly, and you know there's one person to speak to. Whereas if you have many different components and trying to source, each would have to find the interoperability and integration. It makes things just a lot more difficult. So we still believe that NVIDIA's got a very strong competitive moat going out for a few years. Then in terms of the performance and the recent trading, as sort of Chris mentioned, we had news overnight that China, they're applying for a new license to ship the H20 products back into China. But even without this, they had very strong revenue growth last quarter. And then also as well, we just think there's a move now in artificial intelligence to the next stage. We had the sort of training models, these sort of large language models, but now we're moving towards reasoning and agentic AI. So at the start of the year, we had DeepSeek, which was sort of the Chinese large language model, which put a big focus on reasoning. And as we sort of spoke with NVIDIA, actually with more reasoning, it takes more time to think, it requires more compute and greater usage of chips. So we're actually seeing increased demand for NVIDIA's products, as well as sort of Blackwell specifically designed for sort of the reasoning and inference. We also met with robotics companies when we were out there in the West Coast, and again, seeing the sort of changes that are being happening with sort of self-driving cars, for example. It's the motion perception, it's the understanding, it's the ability to react to what's happening rather than just a large language model with text and then sort of an output. Again, we're just seeing so many advancements happening right now in AI that we still believe we're at the very early stages. And so with all of this, it requires a lot more compute. And so as I sort of mentioned before, there's going to be a lot more sort of data center construction, but we're also going to see a lot more different companies in different sectors which are going to benefit from this. So yeah, it's purely simply the construction part of things. There's going to be the energy supply. How do we get all this power? The source of energy as well are going to change. We're seeing sort of changes happening in sort of the manufacturing, sort of digital twins, sort of robots within the warehouse, as well as, of course, just the standard kind of consumer-facing companies like sort of Google, like Meta, in terms of digital advertising. So you can see here we've got some of the world-class companies which are also got exposure to AI, be it Alphabet, Amazon, Amphenol, and Eaton, all benefiting in their own ways. And we still remain very confident that we're at various stages of AI and we have a very good exposure towards it. And so with that, I'll pass it back to you, Chris.
Yeah, thank you very much, Giles. And I think it's very important, that we take a fundamental approach and base our decisions on facts. And I think we've seen in particular with the volatility around NVIDIA, the concerns around DeepSeek that Giles was alluding to, how important it is to keep a long-term perspective and to base one's decisions on those facts. We wrote an investment insight that we shared at the beginning of the year around DeepSeek, where we said that it was an indication for what applications can do and how much that would drive the demand for the computing power that you need in order to have the large language models and then to have the foundation on which these applications can be built. I think that judgment has been absolutely right, and it was based in part on the research that Giles and the team have done to say that this application and the approach is something that has been widely known. It was something that was talked about by Mark Zuckerberg and others before the release came out. And of course, that was the trigger for the volatility. So having this kind of perspective and doing as we do, a process where we talk to each of the companies that we're invested in and asking them, as long-term investors, how are you allocating capital? What are you doing to adapt to the changes to make sure that you're not going to get disrupted by this new ability to take the data that you have, to have the computing power to be able to analyze it, to get to greater effectiveness, greater productivity, better outcomes that we think is going to affect the global economy in the way that computing or mobile or cloud have affected it. And have allowed the companies that have been able to adapt it, to integrate it, to generate returns from it, to prosper in the way they do. And as Giles was alluding to, of course, it's NVIDIA and ASML in our portfolio, which are the direct equipment providers to it. It is the other digital companies that, whether they're platforms in cloud, whether they are benefiting from digital advertising, social media, search, where they're adapting and using their scale, whether it's the software companies that are facing opportunities, but also challenges as enterprise adoption of software is slower because of the complexity around data, or whether it's the other businesses, the industrial businesses that are enabling this, the consumer businesses that are pioneering it in terms of integrating it, in terms of making use of it for their supply chains, but also for engagement with consumers. It's affecting businesses across the board. So we think the important thing is to ask the right questions, to understand what companies are doing, and then build a perspective from that to ensure that our businesses are among the ones that are taking advantage of that. So I think that's important. If we switch on to the next argument that we wanted to make, we just wanted to focus effectively around the stock selection around this. And this is just to look at both the Magnificent Seven to the extent that they're still relevant, but also a handful of other companies that are among the largest and most successful in mostly the US market, but also Novo Nordisk, looking at Europe. And just to make an argument around what we look for when we buy these global leaders. We think we're at a moment where the overall equity markets, and clearly the S&P is the one that is easiest and clearest to observe, are really quite fully valued. There are companies in there that are trading at unsustainable valuations that we don't think are justified by their fundamentals. There's others that are highly valued because of their real and perceived resilience, but also because they have followings that in some cases may be related to retail followings that have priced them to levels that we think are not justified by their fundamentals. We don't think the stocks that we've selected are among those. So we think that the stocks we've selected are either at reasonable valuations that we think are sustainable and where they're going to benefit from the growth in their revenues, their earnings, and their cash flows to generate returns of 8, 10, 12% or more over the long term, or they are out of favor companies where, in addition to those kinds of profiles, they also have valuation upsides of 20 to 40%, and in some cases more, because they have in fact derated, including as a result of concerns about the Trump administration policies this year. So we think our portfolio is very well positioned to generate value from here. If you compare that to the market, and if you look at that in terms of not just absolute but relative performance with more fully valued markets, we think there is a contrarian case for active investing, for picking the right types of companies in this more fully priced environment, for picking the resilient ones that have the quality to prevail. And of course, we think that finding quality companies with the characteristics that we're looking for at the valuations that we buy them at are the ones that should be able to do well. And I think you can see that that also in the absolute and relative performance in particular, as it's been picking up, as we have going into a paradigm where we have somewhat greater visibility around what may happen in terms of some of the policy issues that we're facing. And you can just see that here in terms of some of the numbers. The growth expectations are in some cases variable for different companies depending on the comparisons that they're facing and what is going on in those businesses. But you can see that on balance, the businesses that we're invested in, as this is just looking at consensus estimates to be able to share them, are trading at very, very reasonable valuations. We think, for example, that a company like Alphabet that clearly is facing issues in terms of concerns around disruption from search is at very attractive valuation levels. From which we think there is a very substantial upside. We think companies that have done better, like Amazon, Meta this year, even NVIDIA, if you look at the numbers and the expectations for the growth in earnings that they are able to achieve are actually at very reasonable expectations. And that's very different from the much higher valuations for some of the largest companies that are out there that are either growing at lower levels, like, for example, Apple does, or that are trading at much higher multiples, including some of the highest quality companies out there, like Walmart or Costco, for example, that we think are simply too expensive. And even though they're on our approved list, are stocks that we would like to buy if they got cheaper. So it's just to basically say and put that into perspective. And if you then also just look at the share price performance of some of these specific stocks, I think Apple is one of the ones where I think is most apparent. I think Tesla is, of course, another case, although both from a quality and from a valuation perspective, it is not a stock that we think is attractive. But also, if you look at Eli Lilly and Novo Nordisk over the time frame, you can see that our framework of being very disciplined about applying our quality criteria to the stocks, but then also being very disciplined about the valuation that we're prepared to pay for them, has allowed us within this universe to select a number of the best performing stocks that gives us the confidence that where we have opportunities or where there's been underperformance, that the portfolio is poised to perform from where we are. And then to move forward, the other area that is clearly an issue, and we've highlighted that, I think, very clearly looking at the attribution that we've shared, is in the consumer area. That is an area where there's been particular concerns around what the consumer demand is. And it's both a question of how much of it is cyclical, because in particular of the dislocation from the pandemic, the consumer spending that was enabled by the transfer payments that took place from governments, the shift in consumer spending as we reopened, and then the shock to consumer spending from the inflation and the interest rates, a normalization that we've had since then. So it's been an exceptionally challenging 5-year period that I think we have to have this kind of long-term perspective on, where we're right now at a moment where we have a very significant squeeze that has taken place, a year where this year we thought that there was going to be a reversal because of higher consumer confidence, employment, and real wage growth, but that has clearly been impacted now by the uncertainty. If you look at the surveys around consumer confidence, it's in particular around tariffs. It's around actually the tensions with China, in addition to interest rates and inflation concerns. So there's a lot that consumers have to deal with. We think they've actually been resilient in the face of it, but it has been reflected in the performance of these stocks and in their share prices that are in many cases well below their 5, 10-year and longer term averages, which is just a simple way of looking at these valuations. We base our decisions on cash flow based valuation, but you can see it here in terms of price to earnings ratios as well, which is again why we think that these companies represent outstanding opportunities at the valuations that they're trading at. We're reevaluating them, of course, at all times to our universe, to our watch list and our approved list, and where we have opportunities to buy others, because again, these are not the only consumer companies that have been impacted by what has been going on. We will take advantage to buy potentially even higher quality companies at more attractive valuations and with upside potentials. But we think that this reflects a great opportunity, and it's the reason why we maintain these positions and we have the exposure in the portfolio. We're starting to see some of that resilience, and we're very confident that as we move forward and get through this period, even given the uncertainty that we should start to see returns from those. So then that just gets me to the conclusion in terms of the outlook. One of our favorite quotes from Charlie Munger, Warren Buffett's business partner, is that micro is what we do, macro is what we put up with, and we have been putting up with a lot of macro. I've outlined some of the issues, and so I don't think I am going to repeat them here. If you have more questions, we can go into that in the Q&A. But I think the key point is we're at the point where we're looking to the second quarter results and to the outlook for the year. We're looking to a resolution in terms of where in particular these tariff negotiations are going to end up with. We're not going to have final resolutions. I don't think that is what President Trump does. So whatever gets agreed certainly is always going to be up for renegotiation. But again, the range appears to be coming in, and there's ongoing signs of pragmatism and of guardrails. And I think the big question is, what is this impact on corporate and consumer investment and spending behavior going to be from the uncertainty? We think the underlying fundamentals continue to be strong. We think the demand for the investment is necessary. We think in particular, as we've said, that this investment in data and in computing capacity is significant, but as we said, infrastructure and other areas are strong as well. And so we think that we should be confident about the outlook as we get through this. And if we do have another bout of volatility, as we may well have, as a result of concerns around that, we think that that will be another opportunity, like the one was in April, to buy great companies at lower prices. And we're actively looking at our stocks, our investment universe, the watch list and the approved list, to take advantage of that.